Ever hear people say things like, "I'm buying the dip," "I just invested in Tesla," or "I made money while I was sleeping," and you just sit there wondering, what are they actually talking about? Because at first glance, stocks sound complicated. Charts, percentages, green and red candles, financial jargon everywhere. But the truth is actually much simpler than most people think. In fact, once you understand this properly, you'll realize something surprising. Most wealth in the modern world is not built by working harder. It's built by owning things that work for you. Let me explain. Part 1. What a stock really is. Simple truth. A stock is not a complicated financial instrument. It is simply ownership. That's it. When you buy a stock, you are buying a small piece of a real company. Nothing more, nothing less. Think of it like this. Imagine a bakery in your neighborhood. It sells bread every day. Now imagine that bakery is divided into 1,000 pieces. Each piece represents ownership. If you own one piece, you own a part of the bakery. That means if the bakery makes profit, you indirectly benefit. If the bakery grows, your piece becomes more valuable. If the bakery struggles, your piece becomes less valuable. That is a stock, not magic, not gambling, just ownership. Most people think stocks are numbers moving on a screen, but in reality, stocks are pieces of real businesses, with real customers, real products, and real money flowing through them. Part 2. Why companies sell stocks. Now you might be thinking, why would a company sell ownership at all? Why give strangers part of your business? Simple answer. Growth requires money. Let's break it down. A company might need money to open new branches, hire employees, build factories, develop products, expand into new countries. Instead of borrowing from a bank, they can sell ownership in the company. This is called raising capital. And in return, investors become part owners. Imagine a girl named Aisha. She owns a small clothing brand. She makes good designs. People like her clothes. But she has a problem. She only has one small shop. She wants to expand, but she doesn't have enough money. So she does something interesting. She invites investors. She says, "I will divide my business into 10 parts. If you buy one part, you own 10%. Now someone called Daniel believes in her. He invests $1,000. Now Daniel owns part of her business. If the business grows, Daniel benefits. If it struggles, Daniel loses value. That is stock investing in real life. Buying stock is not betting on price. It is betting on human effort, execution, and time. Part 3. How investors actually make money. There are two main ways people make money from stocks. 1. Price growth. If a company grows, your ownership becomes more valuable. You can sell it later for profit. 2. Dividends. Some companies share profits directly with owners. It's like receiving part of the company's earnings. Even if you don't sell anything, you still get paid. Part 4. What can go wrong? Now let's be honest. Not every story goes up. Some companies fail. Some businesses collapse. Some investments lose value. Let's say Aisha's brand struggles. Competition increases. Sales drop. Now the company is worth less. Daniel's $1,000 might become $700. That is the reality of investing. There is no guarantee, only probability. Stocks are not about certainty. They are about survival over time. Good companies survive. Weak companies disappear. Part 5. Where stocks are bought. Stocks are not bought in secret places. They are traded in public marketplaces called stock exchanges. The biggest ones include New York Stock Exchange, NYSE, Nasdaq. Think of them like giant digital markets, where ownership pieces are exchanged every second. Today, you don't need to visit any building. You can buy stocks from your phone in minutes. Imagine someone sitting in traffic. They open their phone. They buy a small piece of Apple. While stuck in traffic, they become a partial owner of one of the biggest companies in the world. That is modern investing. Part 6. Types of stocks, simplified. There are two main types. 1. Common stock. This is what most people buy. It gives you ownership, voting rights, growth potential, but also higher risk, no guaranteed income. 2. Preferred stock. This is more stable. It gives you fixed dividends, priority during payouts. But no voting power, lower growth. Think of it like common stock equals owning a growing startup. Preferred stock equals stable income asset. Risk and reward always move together. Higher growth usually means higher uncertainty. Part 7. Why people invest in stocks. Now the real question. Why not just save money in a bank? Simple. Because banks grow money slowly. Stocks grow money over time. Historically, stock markets have returned more than savings accounts over long periods. But here's the truth. Stocks are not smooth. They go up and down, sometimes violently. That's why most people struggle. Imagine your money drops 20% in a few weeks. Most people panic. They think, I'm losing everything. So they sell. But the people who stay calm often recover and grow over time. Investing is less about intelligence and more about emotional control. Part 8. The real secret most people miss. Here is what nobody tells beginners. Wealth in stocks is not built in fast moments. It is built in boring moments. When nothing feels exciting. When nothing feels like it's happening. When your account grows slowly. And you don't quit. That is where real wealth forms. Imagine two people. Person A invests $1,000 once and forgets. Person B keeps waiting for the perfect time. 10 years later, Person A has growth. Person B has nothing invested. The difference is not knowledge. It is consistency. The biggest advantage in investing is not money. It is time plus patience combined. Conclusion. So now you know what stocks really are. They are not magic. They are not gambling. They are ownership in real businesses. Businesses that grow, struggle, compete, and survive over time. And if you understand that, then you already understand something most people never fully grasp. Wealth is not built by predicting the future. It is built by owning pieces of it early and letting time do the work. If you enjoyed this video, don't forget to like, subscribe to Maskcreationz, and turn on the notification bell for more simple financial tips and wealth-building strategies. Thanks for watching, and remember, every smart financial decision you make today can create a better future tomorrow.